Welcome to Long-Term Yield. This is the channel for investors who believe the best returns come from owning great companies for 10 years or more. No hype, no day trading, just calm, data-driven analysis of one stock every single week. Let's get into today's deep dive. Right now, the cheapest stock in the Magnificent Seven isn't some forgotten loser. It's a company growing revenue 26% a year, and it just fell 27% from its high. Meta Platforms, $1.4 trillion. 3.5 billion people use its apps every single day. $215 billion in revenue. And it trades at just 16 times next year's earnings, cheaper than the S&P 500 itself. So why is it on sale? One number. Wall Street is terrified that Meta will spend up to $145 billion next year building artificial intelligence. The stock dropped 6% on that news. But here's what the panic is missing. The payoff is already showing up in the numbers. In this video, the business, the bull case, the bear case, the valuation, and exactly where I'd buy. This is long-term yield. One deep dive a week on a business worth holding for 10 years or more. Today, Meta. Let's get into it. Meta started in 2004 as a college project called Facebook. 20 years later, it owns 4 of the most used apps on the planet: Facebook, Instagram, WhatsApp, and Messenger, plus a fast-growing newcomer called Threads. This is not a single app. It's the largest communication network in human history. The company runs on 2 engines. The first, the family of apps, is the cash machine. It's almost the entire business, and it runs on advertising. The second, Reality Labs, builds the future. Virtual reality headsets, and those Ray-Ban smart glasses. Small today, but it's the long-term bet. Let's talk about that scale, because it's almost hard to comprehend. 3.5 billion people open a Meta app every single day. That's nearly 3/4 of everyone on the internet. When a network gets this big, it feeds itself. More users pull in more advertisers, and more advertisers fund better products that pull in even more users. And here's how that scale turns into money. Meta sells attention. Advertisers bid to reach you, and Meta's AI decides which ad you see and what it costs. In the most recent quarter, the number of ads shown rose 19%, and the average price of each ad rose 12% at the same time. More ads at higher prices. That is pricing power. This reach is global. The United States and Canada bring in the most money per user, but Europe and Asia-Pacific are where the billions of users live. And the newest app, Threads, just crossed 500 million monthly users. A serious rival to X, built in under 2 years. Now, the financials. And this is where the story gets serious. Go back to 2021. Revenue was $118 billion. Today, over the last 12 months, it's $215 billion. That's revenue growing 26% in the last year alone, for a company already worth more than $1 trillion. Megacaps are not supposed to grow this fast. But growth means nothing without profit. And Meta is one of the most profitable businesses on Earth. For every dollar of revenue, about 82 cents is gross profit. 41 cents is operating profit. These are software margins at the scale of a small country's economy. The average company in its industry earns far less. Run that through to the bottom line. Net income over the last 12 months, $70 billion. Earnings per share, $27.51. And next year, analysts expect that to jump to around $35. That's the engine behind the cheap valuation we'll get to in a minute. Then there's the cash. Meta generated $124 billion in operating cash flow over the last year. After it pays for everything, including that enormous AI build-out, It still kept $48 billion in free cash flow. Most companies would kill for the cash this business throws off after spending a fortune on the future. And the balance sheet is a fortress. Meta sits on $81 billion in cash and investments. Its total debt, measured against earnings, is just 1/2 of 1 year's profit, almost nothing for a company this size. Interest coverage is nearly 60 times over. This company could not go bankrupt if it tried. Profitability on the capital it uses is just as impressive. Return on equity, 33%. Return on invested capital, 25%. And on the famous Rule of 40, where you add growth and profit margin and hope to clear 40, Meta scores 67. It is, by almost every measure, an elite business. Now, the dividend. Meta only started paying one in 2024, so the yield is tiny, about 1/3%. Don't buy this for income, but they already raised it once, and the payout is under 8% of earnings, so there's enormous room to grow. The bigger shareholder return here is buybacks. Meta has been steadily shrinking its share count. Here's the part the market is sleeping on. In the most recent quarter, Meta's core advertising business grew 33%. Net income jumped 61%. Earnings beat expectations by 61 cents. The actual business is accelerating. At the exact moment, the stock is falling. The fear and the fundamentals are pointing in opposite directions. And this isn't a one-off. Look at the last 10 years of earnings reports. Meta has beaten Wall Street's profit estimate in almost every single quarter. Quarter after quarter after quarter. When a management team hits its numbers this consistently, you should pay attention when the market panics. So let's build the bull case. 5 pillars. Here's why this could be a 10-year compounder. Pillar 1. Artificial intelligence is already paying off in advertising. This is the key point. AI decides which ad you see, and it's getting better at it fast. That's why impressions and prices are both rising. If AI lifts ad efficiency just 10% across 3.5 billion users, that's $5 to $10 billion of extra revenue. For spending Meta is already making. Pillar 2. The AI agent bet. Meta spent over $2 billion buying an AI company called Manus and launched a new model called Muse Spark. The idea, AI assistants that do real work, that people and businesses pay for. If even 5% of users paid $10 a year, that's nearly $2 billion of brand new revenue that has nothing to do with advertising. Pillar 3. Meta can afford all of it. $81 billion in cash, 41% operating margins. It funds the entire AI build-out, Reality Labs, and acquisitions straight out of its own profits, without borrowing and without touching the core business. Very few companies on Earth can spend like this and still grow earnings. Pillar 4. Reality Labs is a free lottery ticket. Today it's small, just over $2 billion in revenue, and it loses money. But those AI glasses and headsets are Meta's bet on whatever replaces the smartphone. If it ever reaches even 1/10 of the size of the app's business, that's another $5 to $10 billion. And you're paying almost nothing for that optionality today. Pillar 5. The moat. This is the one competitors can't buy their way around. 3.5 billion daily users create a network effect that compounds. Every user makes the platform more valuable to advertisers, and every advertiser dollar funds better AI that keeps users engaged. Meta's own moat rating is wide, scoring 9 out of 10, with the network effect itself a perfect 10. But no honest analysis skips the risks. So let's flip it. Here is the bear case, and it is genuinely serious. Risk number 1, and this is the big one: spending. Meta plans to spend up to $145 billion next year, mostly on AI infrastructure. That's double what it spent last year and roughly a third of all its revenue. If that spending doesn't produce returns fast enough, free cash flow shrinks and the stock gets re-rated lower. This is the single reason the stock is cheap. Risk 2. Reality Labs is a money pit, for now. It has lost tens of billions of dollars over the years with little to show in revenue. If virtual reality and smart glasses never go mainstream, that's capital lit on fire, and investors will eventually demand Meta stop. The optionality I called a lottery ticket can also just be an expensive habit. Risk 3. Regulation. Almost all of Meta's money comes from advertising, which depends on collecting data about you. Governments around the world are tightening rules on privacy, on AI, on what platforms can do to children. Any one of those could directly cut into how well Meta targets ads. When your whole business is one revenue stream, regulation is an existential lever. And risk 4. The law of large numbers. Daily users grew only 4% last quarter, and dipped slightly in some markets. When you already have 3.5 billion users, there just aren't many people left to add. Future growth has to come from squeezing more money out of each user. And advertising budgets shrink fast whenever the economy wobbles. So how does Meta stack up against the competition? And against its own price history? This is where the thesis really comes together. Here are Meta's main rivals for advertising and AI: Google, with its search and YouTube empire; TikTok, fighting for younger users; Amazon, using shopping data to sell ads; and Apple, whose privacy changes already hurt Meta once. But look at how they're priced. Meta trades at 21 times earnings. Google, 28. Netflix, 25. Reddit, 47. Meta is the cheapest serious name in the entire group, and the moat that protects all of this is rated wide. The highest tier. Why? 3 reasons stacked on top of each other. Network effects from billions of users, switching costs that lock in advertisers who'd lose all their data and targeting if they left, and economies of scale no new entrant can match. Analysts describe it as a barrier unlikely to be overcome for decades. Which brings us to the only question that matters for a buyer today. At $577 a share, is Meta actually cheap, or is it cheap for a reason? Start with the multiple. Meta trades at 16.5 times next year's earnings. Its own 10-year average is closer to 26. So you're buying one of the best businesses in the world at a 35% discount to the price investors have normally paid for it, while it's growing faster than ever. The cheapness isn't a guess. It's cheap against its own history. Now, the models. A discounted cash flow valuation pegs Meta's intrinsic value far above today's price. The data source I'm using puts fair value north of $900, and its aggressive cash flow model goes even higher. I don't take those literally. But even a conservative view, next year's $35 in earnings at a fair 18 to 20 times, lands you around $650 to $700. Today's price is $577. Here's the chart, and it tells the same story the valuation does. Meta is trading below every major moving average: the 50-day, the 100-day, the 200-day. It's sitting near the bottom of its one-year range, around 520 to 580. Technically, this is a stock that has been beaten down and left for dead by the momentum crowd. So here are my buy zones. From here down to about 520. The recent lows I'd call accumulation. That's where the risk-reward starts to look good for a 10-year hold. Below 520, if fear takes over, that's a heavy buy zone. And above roughly 750, back toward the old high, I'd stop adding and let it run. For position sizing, I'd treat Meta as a 3 to 6% position. Let's bring it together. The bull side, a wide moat business growing 26%, AI already lifting ad revenue, a fortress balance sheet, and a stock trading below its own historical multiple. 5 reasons this can compound for a decade. And the bear side, honestly stated, a $145 billion spending bet that has to pay off, Reality Labs bleeding cash, regulation hanging over the whole ad model, and user growth running into a ceiling. Buy this knowing exactly what could go wrong. So, what's the math over 5 years? Revenue compounding in the high teens, margins holding near record levels, buybacks shrinking the share count, and a multiple that just has to drift back toward normal. Put those together, and you don't need a miracle. You need Meta to keep being Meta. That points to mid to high teens annual returns from here, with real upside if the AI spending pays off. That's Meta, the cheapest of the giants, hated for the one thing that might make it bigger. If this breakdown helped, subscribe. I do one of these every week. Tell me in the comments which stock I should cover next. And the usual reminder, I'm not a financial advisor. This is not financial advice, and everything here is for education only. Always do your own research before you buy anything. Thanks for watching Long-Term Yield. That's it for today's deep dive. If you enjoyed this video, please hit that subscribe button. It costs you nothing and tells YouTube to send you the next one. And drop a comment below with the stock you want me to cover next. I read every single comment personally, and I cover one new ticker every week. Remember, this is long-term yield, real numbers, real analysis, on real businesses worth holding for the long haul. I'll see you in the next deep dive.